Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Job market softness fuels rate cut hopes. Well, there hasn't been a tremendous amount of job creation lately, with just an average of 58,000 payroll additions per month over the last 6 months. That compares to an average of 160,000 a month in the prior 6-month period. This past week showed even more weakness, with the ADP employment report of private sector payrolls actually shrinking by 32,000 during the month of November. Now, despite that weakness, jobless claims have been holding near multi-year lows, causing many to dub this as the no hire, no fire economy. Essentially meaning that there's not a lot of new hiring going on, but companies are hanging on to the employees that they already have, for the most part anyway. Now, many are blaming the lack of hiring on the rise of AI, although the evidence for that claim is still a little bit debatable. Nevertheless, it does make sense that there could be some structural shifts occurring in the employment market as the economy evolves. Either way, the market's getting more excited that another rate cut is on the way due to softness in the labor market. Stock market should be careful what it wishes for, however, if this becomes a harbinger of economic weakness ahead. For this week's featured insight, ignore short-term price swings. If you're a long-term investor, you shouldn't be focused on what market prices are doing on a daily basis. It might be fun to watch, but the market is going to test your emotional intelligence, and it's going to get you to make bad decisions time and again if you give in to your emotions. It's much more important to have a disciplined strategy and investment plan that you stick to regardless of what the market is doing. Now, if you can't stomach the volatility, that's okay. Just know you should keep a smaller portion of your portfolio in stocks and accept the fact that your average rate of return will likely be somewhat lower than an investor who's willing to accept larger fluctuations in the value of their portfolio. What you absolutely should not do, however, is swing back and forth from pessimist to optimist based on price swings in the market, because more likely than not, you'll end up with poor results. Looking ahead, tax dynamics could drive year-end trading. So as we get closer to the end of the year, tax considerations may increasingly drive investment decision-making. You need to be aware of this when you evaluate any individual stock opportunities you may be focused on. Given that investors are looking to harvest losses and avoid taking gains this late into the year, it could cause stocks that have underperformed to experience even more selling pressure as investors harvest their tax losses, while the outperformers could continue to rise due to a relative lack of selling pressure. Keep in mind, however, this dynamic could quickly flip come January, with the biggest winners in 2025 seeing immediate selling pressure, while oversold losers may experience a bounce. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.